Good morning, everyone. This is Jeremy Morris, a tax partner out of our Jefferson City office, welcoming you to our latest BOSS webinar, Maximizing the Employee Retention Credit. I'll be joined, as seems to be tradition these days, by Mark Gingrich here in a minute, a tax partner out of our Columbia office. Welcome all of you who are here this morning. Happy to have all of you on this webinar. A few housekeeping items that we've mentioned. We have muted all participants to try to keep the background noise to a minimum. We could have upwards of 150 individuals on this call today, and we're excited about that. But to help keep that chaos to a minimum, we have everybody muted, but please, we will try to answer questions as we typically do throughout the process, and hopefully have time at the end to answer questions. Please use the Q&A function to ask questions. And again, we will be monitoring that as we go along. We will also be recording this webinar, as well as providing the slides and the audio and slide recordings associated with it, hopefully later today. So with that, then we'll keep moving forward because we think we do have a pretty full presentation today. So we're going to be discussing something that is going to seem a little bit familiar, but different than what we've done recently. And that's this idea of the employee retention credit. And the reason it seems familiar is because it's related to a topic, it's related to a benefit that we've talked about in other areas, and that's providing a benefit for maintaining employees. So if we could, though, it's something that came in with the CARES Act, but it's something that we really haven't paid much attention to. So we thought maybe it would be good to provide some background as to how we got here. So we're coming up in a few days on the 1-year anniversary of the passage of the CARES Act, which I believe was the second main COVID relief bill that was passed back on March 27th of 2020. It was, like some of the bills that came behind it, designed to provide economic stimulus to help businesses get through this pandemic crisis. One of the provisions in this bill was the creation of an employee retention tax credit. And so it was designed to help businesses that were in some way had uncertainty or were suffering because of the COVID pandemic. And when we say suffering, they were either suffering significant reductions in revenue, or they were forced to fully or partially suspend their operations due to a COVID-related government mandate. But it was provided to provide them the ability, it was given, I guess, to provide them the ability, given those concerns, the ability still to maintain levels of payroll. So if we look then at what it did generally, moving along to the next slide, for 2020, the way this credit was originally set up was it maxed out or maxes out at $5,000 per employee annually. So it's not an insignificant credit. So in this simple example, if you have a small business, say a 50-employee business, that business could receive up to $250,000 in tax credits under this benefit. And yet, so here we have a relatively significant tax credit, and the response from most businesses and advisors, including WK, was a shrug of the shoulders and kind of a meh sort of response. So Mark is going to get into then why exactly we had this response. Was it irresponsible in our part, or what exactly prompted us to ignore this credit that's been in existence for almost a year? So with that, Mark, I'll turn it over to you for the answer.
Of course, the reason is because the PPP program came into effect, and we spent the better part of the last year talking with our clients about the twists and turns and roller coaster we've been on with respect to the PPP. If we can advance to the next slide, we'll see that the PPP and the employee retention credit were alternatives. They were mutually exclusive, as you see there on that second bullet point. So when we were thinking through which of them should we get more excited about, we said, let's get excited about the one that gets our clients the most amount of money. And that was the PPP. So we have an example there at the bottom that illustrates 50-person business that we just looked at, a $250,000 potential benefit under the employee retention credit. And under the PPP, that business was going to get $416,000. 416 is greater than 250, easy choice.
Yeah, and so as Mark rightly said, we're at a situation where we can only do one of two. Let's do the one that's going to provide the most benefit, which is PPP. So that then brings us to where we are today. And so why exactly are we talking about this now here on March 23rd, 2021? Well, let's back up. December 27th of last year, President Trump signed into law the Consolidated Appropriations Act, which was a year-end government funding bill, as well as another massive COVID relief bill. Among other things, one of the main things that this bill did was it removed that restriction on ERC eligibility for those businesses who received a PPP loan. In addition to that, this program not only was it was originally set to be in place only through 2020, the CAA then extended it through Q2 of 2021. It did so with less stringent qualifications as well as a larger potential benefit. So, taking those two things into account, the thing to keep in mind as well is that when we say that that the restriction on ERC eligibility associated with taking the PPP was removed, not only was that removed on a prospective basis through 2021, but those changes were also made retroactive to 2020 to the effective date of the CARES Act. So now we have a situation where we have this employee retention credit, again, this relatively significant benefit to businesses that was heretofore not available to businesses that took the PPP, which was 95% probably of the businesses we work with. This benefit is now open to them. And in addition to that, if we go back just a few weeks, on March 11th of this year, President Biden signed into law the most recent COVID relief bill, the American Rescue Plan Act, or ARPA. That extended the ERC through Q4 of 2021. So we now have this tax benefit that is available to all taxpayers, available to taxpayers regardless of whether or not you received a PPP loan. And it's available to you both on a retroactive basis to March of 2020, all the way up through the end of 2021. And so we now have to sort of switch gears and take a look at, for our clients, do you meet the requirements of this? Because if so, there may be a significant amount of money left on the table. And so with that, then we're going to turn it over to Mark, who's going to take a kind of the first stab at breaking down what this credit means, how it's calculated, and how you qualify for the credit.
Thanks, Jeremy. So we're talking about a very broad group of employers. We're stripping out state and local governments and their instrumentalities is the word. But otherwise, we're talking about people, organizations that have payroll, including our friends in the tax exempt realm. And when we're thinking about who is the employer, we're returning to common law employer concepts. And so, for example, a business that uses a PEO through which it pays its employees, the employer will be the business, not the PEO. And while there's no size limitation or threshold for this program, but as we'll see in a minute, business size does matter when we think about which wages count. And so we'll just put a pin in that for the time being and circle back to that concept. If we can go to the next slide, we have a pretty busy chart here, and we'll make this available post-presentation in a larger format. But the basic way we've designed this is to try to order the questions in a way that's going to prevent somebody from getting excited when they shouldn't be. So as we kind of walk through this, the first question we asked there at the top is how big the business was in 2019. And we said there isn't a per se size cap, but the wages that are eligible for the employee retention credit will vary depending on the answer to that question. So for 2020, you'll see in the top left corner, we've flagged this as a 2020 flow chart. And here in a second, we'll look at a couple of modifications in the 2021. The 2020 flow chart starts off asking, did you have 100 or fewer full-time employees in 2019, pre-pandemic measurement period for most employers? So we're going to look back to before the pandemic, 2019, and figure out how big we were. Then we're going to ask ourselves, did we suffer a significant reduction in gross income? If we did, then we're going to get access to some credit calculation, and then depending on our size, the credit calculation is going to be different depending on if we're under the 100 threshold or over the 100 threshold, looking back to last year. But businesses that held on and didn't suffer a more than 50% reduction in gross receipts, you're not out of the money yet. We have two pathways to get the ERC. One is the substantial reduction in gross receipts, which we talked about a moment ago. And the second is a full or partial suspension of our business operations as a result of a government COVID order. And so either of those will get us to credit. And so the way this flow chart's designed is it navigates, are we big or are we small? And then it kicks you into any of these green boxes. And if you navigate through the entire credit worksheet without passing through a green box, then you are shut out of the program. So for example, if you had more than 100 full-time employees in 2019 and you didn't pay any of your employees while they were idle, so you didn't pay anyone not to work, then you quickly get thrown into the orange box, which is not the place to be. So Jeremy, you mentioned a minute ago an extension to 2021, first through Q2, and then most recently, as of a couple of weeks ago, a further extension to Q4. How do these numbers change in 2021?
Yeah, thank you, Mark. So if we can move on to our second busy slide associated with this. Again, this is marked as 2021. Again, same general concept here if you go through this, but we'll touch on some of the changes that impact 2021. So again, the very first question is a question that Mark asked, again, trying to save us a lot of time on this. Did your business have 500 or fewer full-time employees in 2019? And again, one thing that's the same is that we are still looking at a 2019 baseline. Even though this is a 2021 credit, a common misconception is that we are comparing this to 2020, and that is not the case. Our comparison is to pre-COVID times in 2019. But we can see this is the first main change. The definition of a large business has increased to be a business that has more than 500 full-time employees on average in 2019. And Mark, in a minute, will discuss how we calculate that. So that's the very first question. And then we get to the same question, did you pay any of your employees? If the answer to that question is no, and you had more than 500 employees, you are a large business. And so therefore, the first question after that is, did you pay any employees while they were idle? And if the answer to no is no, then this is a pretty short conversation. Okay, but let's then move forward. So let's assume our business did not have, or I'm sorry, let's stay on the flow chart, but move on to the next change. I apologize. So let's assume then that our business did not have more than 500 average full-time employees for 2019. Then we look at one of our first two gates that we have to go through, and that's whether or not you had a more than 20% reduction in gross receipts for any quarter of 2021 when compared to the same period in 2019. Again, for 2020, you had to cross a more than 50% reduction threshold. That reduction has now been reduced to 20%. Assuming you meet that requirement, then we get to conclusion A, where we have three more potential changes or three more actual changes. One, the ERC is available in that situation on all employees during the quarter you meet the requirements. However, that credit, instead of being a $5,000 per employee maximum, which is what it was in 2020, can now be up to $7,000 per employee per quarter. So with an ERC that's now been extended through 4 quarters, we could be talking a $28,000 tax credit per employee for the entire year. Okay, subject to all of the other various restrictions, which we'll talk about shortly. So that's another change. In addition to that, we'll make note of this a little bit later on, but something to keep in mind was that the original ERC allowed for the credit period to begin when you had a more than 50% reduction and up through the period in which your gross receipts got back up to over 80%. So for 2020, the credit for all in basically all instances was a 2-quarter credit. Okay. Unless you only qualified in Q4 before the extension. We do have an election now that if we cannot meet the requirements in the current quarter, we can look to the immediately preceding quarter in 2021. And we can say, look and see whether that quarter had a more than 20% reduction in revenue, gross receipts. If it did, if the immediately preceding quarter did, we can use that to qualify us for the current quarter. So those are the main differences. If we don't have a more than 20% reduction in gross receipts, then we start looking at the second gate to go through and whether or not our business had a full or partial suspension of operations. But more on that in a minute. So again, same general concept. The number of employees that gets you into the category of a large employer has increased, so fewer businesses will fall into that. It is a lower threshold to get to qualify under the gross receipts test. It's now a 20%, more than 20% reduction versus a more than 50% reduction. And in addition to that, we are now living in a world where the maximum credit per employee in 2021 is up to $28,000 per employee, as opposed to a maximum of $5,000 per employee. So that's why we're talking about this now. Now that this has opened up, again, a significant credit and a bit easier to meet the qualifications. Now, going back then to my comment about the employees, Mark mentioned this earlier, and we'll turn it back over to him to discuss this. There is no strict size limitations. However, the size of your business can cause a problem. And so with that, then Mark, we'll let you walk us through the calculation of the average number of employees and what impact that has on this credit.
Thanks, Jeremy. And before we turn to that, we did have a question come in on the flow chart, and I think it bears repeating. It somewhat feels counterintuitive when you first tackle it, but when we're applying the rules to 2021, we are looking all the way back and comparing 2 years ago to 2019. The thought process being we need to compare pre-pandemic. Okay, so let's turn to employee size. And again, we're going back to 2019 for most businesses and looking at the full year of 2019. So we say size doesn't affect eligibility per se, but it does significantly impact the ERC math. Why is this? Because employers, when we're calculating the amount of the credit, only get to count wages that were paid to employees who were idle. Idle is our word. It's not the statute's word, but it's people who were being paid not to work. Okay, so those are the only wages that count for a large employer. So what they've done is created a cliff. So if a business was at 100 exactly in 2019, they get the 2020 ERC calculated on all wages. If they exceeded that by one person, 101, then they only get to count wages paid to those employees who are being paid to do nothing. And so for many businesses, that may be no such wages. And so while definitionally we're not shut out by being large, functionally, because of the way the calculation works, we can be shut out. So the employee count is really important, especially for those employers who are close to that 100 threshold. We've had some, when we start seeing it and seeing numbers in the 90s, we start to get nervous. But we've also had some clients who have issued hundreds and hundreds and hundreds of W-2s for the year, and yet they still count as small, even under the 100-person FTE definition. Why is that? Let's look at how the math works. So in the bottom right corner, I use the word full-time equivalent, and I wish I didn't. Let's think of that as full-time employee, okay? Full-time employee. So the part that gets confusing is that the ERC tells us to look to the Affordable Care Act definitions of full-time employee. So most of us are used to a concept of full-time equivalent in that definition. but the ERC intentionally uses a different phrase. And so we are looking at full-time employees, which is a much, much different calculation. So you'll see here a hypothetical business, and I stopped it at just a handful of employees. We could have gone all the way to one with hundreds of employees, but I think you would have hated us had we extended the slide quite that much. So let's look at how it works for this example, even though we can tell right away that we're small because our total head count is under 100 people. Okay, so the threshold is the number of employees who averaged 30 hours a week for the month. And so a shortcut calculation that we've applied in almost all instances is to think of the month as consisting of 130 full-time hours. And so we are counting the number of employees each month that hit that threshold. So you'll see here, January, we were at 2, February 2, March 2 again, but a different 2. April, we went back to the same 2 that we had in February and January, and so forth. So we have 3 in April, 4 in May, etc. We add across all 12 months, divide by 12, and that gives us our average full-time employees of between 2 and 3. So if we applied the same methodology to a larger employer, we could have a situation where somebody issues 500 W-2s and their full-time employee count is 60. We could have an example where somebody has 102 employees and we flunk the test because every single one of them is a full-time employee. So again, there's a very specific method of counting, and employee head count is not going to cut it. So Jeremy, let me kick it back over to you. I think we have a couple of questions that popped in that maybe we can answer in real time, and then we can turn to the question of when we're thinking about our significant reduction in gross receipts, how are we going to go about making that determination?
Yeah, thank you. And I would say for Daryl's question, let's table that one for a second, because I believe in approximately, or maybe exactly 4 slides, we get to his question, because it's about what method of accounting can you use for purposes of the reduction in gross receipts. So I would say hold on to that one, and we'll make special note of that when we get to that slide, but we will discuss that. The short answer is it's related to your income tax basis of accounting. There has to be a consistency. As it relates to Ashley's question, where can we find the original official list of what entities were subject to a full or partial suspension of operations as a result of a government order? Mark, I think you've done some work on this. Is that, I assume that's something that statewide, countywide, we just have to look at on an individual basis as it relates to specific industries? Any thoughts or ideas about what would be maybe the most efficient way to look that up?
Yeah, let's hold that question until we go through some of the examples. And then we're going to see that the world is messier than any of us would like it to be. But let's hold on to that one as well.
Okay, sounds good. Matt asked a question just now that came in. It says, we were eligible for an ERC in 2020 and able to take the max $5,000 credit on most employees. If we are also eligible in 2021, are we able to take the difference between the 2021 and 2020 maximum credit on the same employees, or is it an additional $7,000 on those employees? I will answer this one because this is a very happy answer, so I want to be the one to deliver the good news. That is an entirely new credit. So you do not get the difference. If you qualify separately, and again, you've got to do the testing in each separate quarter of 2021, but if you meet the requirements in 2021, that is a new potentially $7,000 per employee per quarter calculation on top of what you already received in 2020. Okay. So with those, then let's take a look at this first gate, as maybe I've referred to it earlier, how we get into the ERC world, and that's this gross receipts test, specifically a gross receipts reduction. Remember, that has to be more than 50% for 2020, more than 21%, or more than 20% for 2021. So we're going to break this down into for-profit entities and not-for-profit entities, because there are some intricacies or some differences between those two. So let's define before we can discuss what is a reduction. What exactly does gross receipts mean? So for a for-profit entity, we are looking at total sales first and foremost. That can be net of returns and allowances. It is not net of cost of goods sold. So it really is a gross sales number. In addition to that, gross amounts received for the delivery of services. That is gross receipts. Again, no big surprise there. But this is where things get a little bit more interesting, not difficult, but just interesting. When they talk about a reduction in gross receipts, we are looking at a reduction in gross receipts from basically every source, not just from operations. So that can also include any income from investments and from incidental or outside sources. And so we've listed them here: interest, dividends, rents, royalties, annuities, and net capital gains. And I emphasize the word net, as well as net gains from the sale of business property, because we will see a difference related to this here in a second. But for purposes of for-profit entities, when we are calculating gross receipts, when we look at capital gains, and when we look at gains from the sale of business property, we are looking at those on a net basis. In other words, we are looking at sales proceeds minus your cost basis associated with those assets. That represents a gross receipt for purposes of the ERC. So that's for-profit entities. We'll let Mark then work through the definition as it relates to our non-profit businesses.
Jeremy, I guess before we exit the for-profit realm, so you're telling me that if I buy a widget for $100 and sell that widget for $200, 200 is my gross receipt. But if I buy a stock for $100 and sell that stock for $200, then I'm only counting as gross receipt the net between my sales price of 200 and my cost basis of 100. And so I'm getting it definitionally a big difference in cost of goods sold, or in my gross receipts number, depending on whether it's ordinary course proceeds or sale of what we think of as a capital asset in tax terms.
That is absolutely correct. What you stated there is correct. Gross sales of inventory are at gross, not reduced by the cost, but you get to a different answer if we're talking a sale of a security or a sale of a business asset. We have a question come in: does business property include real estate sales? Yes. The answer to that would be yes. So the net gain on the sale of real estate would be a gross receipt, both for purposes of the comparison period, which is 2019, and the current period where we're trying to qualify for the credit, which is some quarter in either 20 or 21.
Very good. Okay. So I think that's an important distinction, because now we'll move to not-for-profit land and think about how we count it in this world. And I know that when the ERC first came out, we spent a lot of time working with some of our nonprofit clients trying to sort through these definitions, which were somewhat cumbersome and confusing. So here's all of that distilled learning here on a couple of slides for you. Look at that second hollow bullet point. That's the point we were just making with respect to for-profit entities. For some reason, we have a different rule for not-for-profit entities. Not-for-profit entities, we're supposed to look at the gross sales price of all of our assets sold. So we're not drawing a distinction between what we think of as program revenues or sales in the ordinary course and the proceeds from sales of capital assets. So for not-for-profits with endowments, this can create just some weird things that happen depending on what the sales volume was in any particular quarter of 2019 compared to the same quarter, the corresponding quarter in 2020 or 2021. So some weirdness in the definition. You're going to get some anomalous results as a result of the way that they've drawn the lines. But that's a big distinction between our for-profit and not-for-profit clients. Note there on the second solid bullet is, of course, just like our for-profit friends, we're not going to take our fundraising costs or those types of things, and there's no netting. We're really looking at a gross number. If we advance to the next slides, we have a kind of a laundry list of all the things that are gross receipts for ERC purposes: contributions, gifts, grants, dues, assessments, gross sales proceeds, as we've talked about, gross amount received from the sale of assets without reduction for cost or other basis or expenses of sale. So super gross in the not-for-profit world, as well as any of our investment income, interest, dividends, rents, royalties, and the like. Okay, Jeremy, so we've talked about what is gross receipts. Now, how the heck do we measure this? We got cash basis clients, we got accrual. How do we think about this?
Yeah, thank you. And so we typically think about this on the basis of the Internal Revenue Code. So what is your basis of accounting for income tax purposes? So that gets to Daryl's question. And here's the reason why. In these instances, the definitions of gross receipts as it relates to both for-profit entities and not-for-profit entities, those are tied to definitions that are within the Internal Revenue Code or the regulations. And in both instances, they require gross receipts to be determined under the taxpayer's federal income tax basis of accounting. So to Daryl's question, it doesn't really matter what the book basis is. If your book basis accounting is your tax basis accounting, that is what you use. You cannot then switch to a GAAP basis of accounting that is different from what you use for income tax purposes in order to calculate the reduction. So it has to be on an income tax basis of accounting. We don't get to pick and choose the methodology. We kind of talked about that a little bit as it relates to PPP. This is a slightly different outcome where we are generally stuck with our basis of accounting for income tax purposes. Here's something to keep in mind, though, as we talk about planning, is that the one thing that the ERC does not require is it does not require the reduction in any way to be tied to COVID-19. And we'll see that that is a key component to some potential planning associated with this tax benefit. So we need a reduction in gross receipts. We need it to be at least 50% for 2020, at least 20% for 2021. But there's no requirement that we have to show that it's in any way connected to COVID. And this has significant planning implications, particularly as it relates to our cash basis taxpayers. So moving to the slide, we're going to give you an example. All right, we have companies A, B, and C. We've listed their 2019 gross receipts as well as their 2021. And let me just take a pause here for a question that Lori asked while I'm thinking about it, because it impacts this schedule. In any circumstance, when we talk about using the prior quarter or the current quarter to determine whether or not there's an ERC, we are always and everywhere using the 2019 as our baseline. So when we look at, does a quarter in 2021 qualify? If we are in quarter two and we want to compare quarter two, we look at quarter two 2021 versus quarter two 2019. If we want to qualify based upon the prior quarter, we would look at quarter one 2021 versus quarter one 2019. The comparison is always against the equivalent quarter, or as they say in the code, I think the corresponding quarter in 2019. So we have gross receipts for 2021 for these businesses on the quarter basis, looking at quarters 2 and quarters 3. And then we also have their 2019 gross receipts for comparison purposes. To make the math simple, we have 3 identical companies in 2019. All 3 of them had $200,000 worth of gross receipts in quarters 2 and 3, separated equally, or divided equally among those 2 quarters. Let's look at what happened to each company in 2021. Company A was flat from a gross receipts standpoint in quarter 2. However, it had a significant reduction in gross receipts in quarter 3. That reduction was $42,000 or 42% of gross receipts from that same quarter in 2019. So overall, Company A had a 21% reduction in gross receipts combined for quarters 2 and 3, but all of it was recognized in quarter 3. Compare that to Company B. Company B had the same $100,000 of gross receipts per quarter in 2019, but Company B had a reduction of $21,000 in gross receipts in both quarters 2 and quarter 3 of 2021. So company B also had a 21% reduction in gross receipts combined for the 2 quarters. However, because of the way the rules are set up, this is calculated on a quarter by quarter basis. So company A is only going to receive the ERC benefit for quarter 3. Company B, on the other hand, which is in the exact same position economically as company A, is going to be able to take an employee retention credit for both quarters 2 and quarters 3, potentially doubling up the benefit of the credit. So you can see where some of the weirdness comes into play when we start actually doing calculations. And then let's take a look at company C. Company C for right now is the easiest situation to be in. Company C actually had a 10% reduction in gross receipts in quarter 2 and a 15% reduction in gross receipts in quarter 3. So company C does not qualify for either quarter of 2021. So that's, in our example, the reality of what has happened. Mark now is going to take us through basically an exercise of what if and what happens if we change a few of the assumptions or some of the actions by these companies to see if they can in any way influence the amount of this credit.
Thanks, Jeremy. And just I guess to put a fine point, because I know we're getting some questions on this, that there is this election to use a substantial or significant reduction in one quarter to also bleed in and qualify you for the next quarter. So as we were looking at those examples a moment ago, we were looking at it just which quarters suffered a significant reduction. And so, you know, the ones that happen to find a significant reduction in Q2 and in Q3 will also have the ability to elect in Q4 to use Q3's measurement. So they'll actually get the credit for 3 of the 4 quarters this year. And then, you know, the testing on Q1 will kind of stand on its own. So as we saw there, we drew 3 companies that had identical 2020 years and saw each of them go a slightly different way with 2021. And I'm sorry, they had identical 2019 years, and then we saw them go a different way with 2021. And so let's think about what Jeremy told us about our method of counting revenue. So let's assume that companies A and C, which were our 2 companies that missed a quarter, they each missed Q3. And in the case of company C, it also missed Q2. So their cash basis, well, what does that mean? That means that they recognize revenue when cash comes in the door. So let's think about strategically what they might be thinking about. We know what the revenue threshold is to meet the ERC definition of significant reduction. If we look back to 2019 Q2, that's a mathematical calculation. We multiply it by 80%, and we know we have to come in at a number that's less than that. Equal to, we flunk. So less than 80% of the 2019 measurement number. So is there a way to engineer that outcome? It seems to us that there is. You know, the easiest way to engineer it, we don't think works. So we think client comes to you with $100 bill, says, I'd like to pay you. You hold out your hand, palm out, and say, no, thank you. I don't want to get paid right now. Pay me next quarter. That's not going to work. You're going to have a constructive receipt problem once your client is trying to pay you. But what if we go one step up the revenue cycle, and instead of declining receipt of payment, which Mark and Jeremy say is a no-no, what if instead we control the timing of our billing? So if we just think back to the prior example, what if we, instead of billing things the way we normally would have, what if we instead had held back $21,000 of invoices until July? Or stated differently, what if we tried to use our invoicing practices to control the timing of receipts to make sure that we look more like company B and less like company A if we think we're going to be down? Or even in the case of company C, where they were flat or up, comparing 2019 to 2021. Maybe there's an opportunity, even if in aggregate for the year we're up, maybe we can get one quarter that's down 20% because Congress set the threshold so dang low for what is a significant reduction when it shrunk it from 50% in 2020 to a 20% reduction requirement in 2021. So maybe we can use our invoicing to control the timing of our cash receipts and engineer a result. So let's advance to the next slide, and we'll see how maybe this could flow through our hypothetical companies. So if we were able to control our invoicing and spread what was a down quarter for company A in Q3 and pull some of that revenue back into Q2, now we're down 21% for both quarters, and we're going to get the credit, taking into consideration this third bullet point below, our election to look at an immediately preceding quarter, which was Congress's way to try to help make sure we get 2 quarters in. We think we're still a little bit light on guidance on this, but it looks to us that we would get, in the example of company A, 3 quarters, quarter 2, quarter 3, and then by election, quarter 4 would refer back to quarter 3. Company B was good all along. And now company C, which is up for the year, they're up 13% for the year, but we've now shifted the timing of their income and deferred income out of Q2 into Q3. Well, if we were able to defer enough income out of Q2 into Q3, and income here is cash receipts for our cash basis taxpayers, we have achieved a result where company C, even though its profits are higher than 2019 levels, is eligible for 2 quarters ERC. So it's counterintuitive. It defies the intent of the legislation, but it's the problem with the arbitrary rule cutting, distinctions that Congress has made, and tying the revenue definitions to the taxpayer's tax basis of accounting. For many clients, that's cash. It really provides the opportunity to control the question whether they have a significant reduction in gross receipts, therefore the question whether they qualify for the 2021 employee retention credit. There wasn't the same opportunity for gamesmanship in 2020, you'll recall, because December 27th was the date the new law was signed into effect, allowing PPP borrowers to participate in the employee retention credit. So we have 1 year where they've given us the rules before we're applying them, and they've written the rules in a way that really allows businesses to influence whether they qualify. And this is an example here with company C, where we have a business that, from a policy perspective, probably shouldn't qualify, who does. The other edge to this is if you look at company B, who's down 21%, there is no silver medal for close here. So if that shrinks to 20% exactly, or to a 19% reduction, then that quarter comes off the board. And so we really have created yet another cliff in the way the statute is designed. The first cliff was how big are you, measured in 2019. The second cliff is, did you have a significant reduction, measured on an all or nothing basis at the 50% or more, more than 50% threshold in 2020, or more than 20% threshold in 2021. So Jeremy, where does that leave us on the first of our gates, as you described it, into the employee retention credit, the significant reduction in gross receipts?
Well, I think you said it, best, where there is no medal, for second place associated with this. This is a cliff. So there are really strong incentives to meet the threshold, because if you're close and you, for example, are considering booking some additional sales, you actually have less incentive to book those sales in those quarters where you're close, because that may be the difference between a significant credit and no credit at all. And so that's really this first bullet point and probably the key takeaway. So if you have a business that is using a cash basis of accounting for income tax purposes, they may be able to actually qualify in these situations at the margins where maybe they would have had difficulty before, but it's going to require a little bit of planning. And it's that same concept that we look at for taxpayers generally at the end of the year, where particularly in a situation where we have changes in tax law, when does it make sense to recognize income? Do I recognize it at the end of this year, or do I recognize it at the beginning of next, to the extent I have the ability to influence that? And so this is really taking that concept on a quarter by quarter basis as it relates to the employee retention credit, using that cash basis of accounting, timing when you may invoice clients or customers or what have you, in order to shift income between periods, in order to help you receive the benefit of the ERC for as many quarters as possible. Because go back to that situation in our very first example. Business A and business B had the exact same reduction in gross receipts, but merely because of the timing, company B received twice the benefit. And as we saw then in the second example with company C, the absolute crazy thing about this is that we can still manufacture a credit in situations where the business is doing well and maybe didn't suffer not only not a net loss, but they didn't even suffer a reduction in gross receipts overall. And again, it's just based upon the way the rules are written and how you calculate to get through that first gate. So that's the key takeaway to that. Let me take a look at some questions before we move on to that second gate. Daryl's question, what if you have the loss on the sale of an asset? My knee-jerk reaction is going to be it's a gain reduced by basis to zero, but I'm not entirely certain that's the right answer. Mark, do we get to reduce for the basis of the assets? Do we know if that allows us to take those amounts below zero? Because if it does, then that would, the timing of recognition of losses would be a planning tool as well.
Yeah, let us try to get you a better answer than I'm going to be able to get off the top of my head on that one, Daryl.
Okay. Yeah, because I was trying to look at it and wasn't able to quickly come up. So I'll let, we can take a look on that. And if nothing else, we'll get you an answer post webinar related to that. The second question, the next question I feel a little bit better about. Well, how about grants from the CARES Act, from the DOE? I assume it's Department of Education. My understanding is I don't think there was anything explicitly excluding those items. So without an explicit exclusion, I assume we're talking about a not-for-profit entity here, that would be fall under grants, gifts, grants, contributions, so on and so forth. All of those are gross receipts for purposes of the ERC. So I think unless there is an explicit item that would allow you to exclude it, an explicit exclusion, that I think it would be included under general grants as any other grant would be included for purposes of the calculation. The next question about, do we need to qualify in consecutive quarters? You do not. As far as we can tell, this is a quarter by quarter calculation. So let's say you qualify in quarter one, and let's say you don't forget the carryover rule. Let's just say you don't qualify in quarter two. You could still qualify in quarter three. You don't have to have consecutive quarters associated with that. And then finally, on the calculation of gross receipts, am I correct in understanding we must reduce them by gross receipts billed to affiliated entities? Yes, that's my understanding on this. The gross receipts calculation is on an affiliated group basis. You would not include gross receipts to affiliates. But again, the key here is that you're being consistent. You would have the same impact in both the baseline period as well as the non-baseline, as well as the current period, in order to not be able to play games with payments to affiliates in order to meet the requirements. Finally, the second round PPP count as gross receipts. Now that is a situation where I believe, I'll find the citation, but I believe that is not included for purposes of gross receipts. I believe that is an item that is explicitly excluded from the definition.
That's
So
right.
a lot of questions, a lot of answers there. Mark, anything you disagree with or want to add to?
Nope, that's good. We'll get a circle back with the group on the answer on the loss situation, which I think is an interesting one for our for-profit businesses. Again, for not-for-profits, it doesn't matter. And that's one of the crazy things about the not-for-profit definition is you can buy something at 100, sell it at 2, and you still have to count the 2 in your gross receipts.
Right.
Okay, so let's talk now to our second gate, and we may have to fly through some of this material, so I apologize for that. But remember, we had two gateways to get to the ERC. We've just covered a significant reduction in gross receipts. The second is a full or partial suspension of our operations as a result of an eligible government COVID order. So let's look at how that works. All right. Our basic requirements are it has to be an order. Must or shall is what we're looking for. Official statements, not off the cuff things at a press conference. So we have a formal order from a mayor saying certain businesses must close by 7 p.m. That's an order. Mayor says at a press conference that we should really do better by doing X, Y, and Z. Not an order. Okay. The order has to relate to limitation on commerce, travel, or group meetings. It has to be due to COVID-19. So if I have a rat running across the floor and that causes a health department order for me to close for some period of time, that's not due to COVID-19. So that doesn't get me ERC. And here's the kicker. The last one, it results in a full or partial, and we'll spend a lot of time talking about partial here in a minute, suspension of our trade or business operations. Full is what it sounds like and would be very restrictive. Partial really opens the door for a lot of businesses that were able to stay largely open to come into qualification. So, Jeremy, we find ourselves, since we've said that it's a government order, and I use the example of a mayor, where a business could be operating in situations where lots of mayors are trying to tell them what to do. So how does that all work?
Yeah, thank you, Mark. Yeah, everyone, if you thought things were interesting before, buckle up. Things are about to get weird because that's what happens. With the planning opportunities associated with the gross receipts reduction, again, we've seen there are some questions that we may not know, that may be unclear, but generally speaking, it is a quantitative calculation. When we live in a world where state and local policies, which again can be as varied as the number of states or localities. When we allow those things to drive federal tax policy, we get some very strange results. And so let's take the example of two businesses. One operates in jurisdiction X. It prohibited indoor dining from March 23rd to 2020, from March 23rd, 2020 through December 31st, 2021. Business B, however, operates in jurisdiction Y. It had a similar rule, but only through March 23rd, 2020 until June 30th, 2020, and then fully reopened July 1st with no restrictions. So basically we have something that looks like Columbia for jurisdiction X and Jeff City for jurisdiction Y with no other commentary provided with that. So one had full year, one had through June 30th. Neither, though, really had a significant reduction in gross receipts. Both of them continued on in roughly the same capacity as they did before, even under these restrictions. They were able to make do. So what happens? Well, in the situation, business A is eligible for the ERC for the wages it paid throughout the entirety of that prohibition on indoor dining, which was March 23rd through December 31st. Business B is also eligible for the ERC, but only for the period of time that the wages were paid during the period of the restriction for indoor dining. So business B is only eligible for the credit from March 23rd through June 30th of 2020. So what happens then if business A made more money in 2020 than it did in 2019? It actually had an increase in gross receipts. Maybe it had a drive-through window. Maybe carry-out business was fantastic. Well, the answer is it doesn't matter, because we're not worried about the gross receipts gate anymore to get through. We have this other gate, and it tells us that if there was a prohibition that was government mandated, that is deemed to be a partial shutdown under the examples. We qualify for the credit regardless of whether we even had a reduction in actual financial, results as it relates to gross receipts or even income. So again, all we look at is when were the businesses subject to the order, and the income and the wages associated with that period of time are subject to the credit. End of story. But it is the end of story, but it's not, because let's take a look at what we mean by a suspension. Because again, these are qualitative type of definitions, not quantitative. So let's take a look at full suspension first, because full suspension is easy. If your business was a non-essential business and it was forced to shut its doors to the public, that is a full suspension of activity. If your business was an essential business and it was allowed to keep its operations open, that does not qualify as a full suspension of activities. But unless it went through the other gate for the substantial reduction. But there's more. We have this concept of partial suspension. And just because you're an essential business does not mean you do not qualify for the partial suspension. As we've said on these slides, things get messy. So here's the general test. We have an employer that operates an essential business, but it has a partial suspension if, under the facts and circumstances, a more than nominal portion of its business operations are suspended by a government order. So again, essential business, the partial suspension comes into play if if a more than nominal portion of its business was suspended by government order. And so that brings forth the question, what exactly is a nominal amount of activity? And for that, we'll kick it back over to Mark.
Thanks, Jeremy. So nominal, this is a problematic definition. The government started using this word nominal over the summer when nobody cared about the ERC because we were in PPP land. Now we care, and we have guidance that came out this spring that says, well, if you had more than 10% of your aggregate gross receipts came from this particular activity, then we agree that that's not nominal. Or if more than 10% of your employee hours were spent in that business line, that we agree that's not nominal. And that's about all they say about that. So we've used the word safe harbor here because we think that if a business were at 10% of gross receipts, the IRS has blessed it as being okay. They've also told us that many of these determinations are fact and circumstance based. And so I wouldn't rule out the conclusion that a business line that made up of 5% of our gross receipts might not be nominal. I don't think it's a pure test or a cliff. I think that I read it as a safe harbor. So I'm going to just rattle off some of these examples. We're going to go fast, but they'll be here for you on the slides post-presentation. Supplier suspends operations as a result of a government order. That has a ripple effect on my business and causes me to close. That's a partial suspension. What if my customers are subject to a stay-at-home order? That drops demand, so I must close the store. Nope. If it's customer-based, it's not a partial suspension. If it's supply-based, it is. Arbitrary distinctions, but they are distinctions from right out of the IRS's mouth. Employer is not ordered to close, but we decide to close because we think it's the right thing to do. Nope, we failed the statutory requirement that we were ordered to be closed. We're ordered to close our work site now, but our employees are able to largely telecommute. And had that capability before COVID. IRS guidance says because we were able to do it pre-COVID, we are out of luck. Business as usual. Everyone go home, work from home. You're still in business, not a partial suspension. Okay, but what about if I have a business, physical therapy type practice is an example. I have specialized equipment on premise. I can do some telework. But I can't do as much as I wanted to. And because the local government has ordered my business shuttered, at least with respect to certain activities, government says, yes, that's fine. That's a partial suspension. Similar example there on the next bullet point. And so the remote work factors the IRS tells us to look at is we're supposed to consider our pre-COVID telework capabilities. We're supposed to consider the portability of our work, the need for presence in the actual physical workspace, and whether there is a significant, and they've defined that as a more than 2-week migration period required to go from the same capabilities in on-premise to same capabilities remote. So if we were entirely a papered office and needed to take a month to move to a paperless environment as a result of COVID, then the government's going to say we weren't shut down for 2 of the weeks, but we were shut down for the extra 2 that it took us to get going. Okay, this was a question we had a moment ago. Employer ordered to close some operations, but not all. And let's assume that the portion that's ordered closed is not nominal. Then yes, we're good. Jeremy, can you walk us through some specific industry examples we have?
Yeah, happy to do so. So restaurants, probably those that have been one of the industries most impacted by this. Indoor dining, if it is closed, that counts as a partial suspension. If you are operating under space limitations that have more than a nominal impact, so again, running significantly fewer tables because you have to maintain 6 feet of distance between them, yes, that counts as a partial suspension. If you're limited based upon hours, in other words, if there is a curfew, you have to shut down a few hours earlier than before, that counts as a partial closure or partial suspension of operations. What if you had to shut down indoor dining but still had drive-through only? That still counts as a partial closure. Retail, storefront closure, pretty easy. That counts as a suspension of activity. However, what if we have a situation where social distancing restrictions permit shopping indoors, but you have to abide by capacity limitations that require some customers to wait in queue for a short period of time outside before they are let in? That actually is not a partial suspension of activity. In the medical field, if a medical practice canceled non-urgent medical procedures, or those were prohibited, I say canceled, but it had to be due to a government order. They were no longer allowed to do those due to restrictions related to COVID. That counts as a partial closure. What if we have a grocery store? What if, say, the salad bar was ordered closed? Well, assuming that is a nominal activity, that does not qualify as a partial closure. So those are kind of quickly through some of the industries. Mark will talk about service delivery and how it is impacted under these rules.
Service delivery modifications are, I think, one of the really tricky and problematic parts of the partial closure rules. So here what we're talking about is we have specific industry examples that Jeremy has run through where pushing a cheeseburger across a counter was the old activity. Requiring that it go through the drive-through window is deemed to be a sufficient modification to represent a partial closure. So how do we extend that example to other businesses, to businesses that move to by appointment only, or prohibit walk-up services, or change the format of delivery of our service? And so the IRS has highlighted a few factors that can represent a partial closure if you have to modify your service as a result of a government order. But again, it reminds us that its intention is that these modifications must have a more than nominal effect on the business operations based on the facts and circumstances. And certainly a reduction in revenue and a reduction in profitability would be good facts, but they are not necessary facts. And so, if my retail establishment is allowed to have people come into the store, but we want to try to take the position that by changing some format of our service delivery in response to a government order, that modification has more than a nominal effect on our business operations, then that's an argument that's available to us to make. But again, there's a clear line in the guidance where we can't look to the preferences or lockdown status or behavior of the of our customers. I apologize for my ringing phone in the background if you guys can hear that. And the the example here is I don't want to wear a mask, so I have some change in my customer behavior where either I require them to wear a mask or I have to deal with the impact of them not wanting to wear a mask, whatever the case may be. That the modifications that affect customer behavior are insufficient in this area. So Jeremy, how do we handle situations where different orders affect different parts of our business again?
Well, and this is a situation where things are getting messy, and this gets to the question that was just recently asked. And so generally speaking, this could be a friendly ruling or a friendly set of regulations associated with this. So if you have businesses operating in jurisdictions, as we've discussed, they are most likely facing different rules. Every, different jurisdiction has taken a different approach as it relates to COVID and the restrictions that it may or may not put on businesses. Generally speaking, however, a shutdown anywhere is a shutdown everywhere. So if you have multiple locations and none of those locations qualifies, would be nominal to the whole, then a shutdown in one is deemed to be a shutdown in all. And so therefore the wages in all of those locations would be subject to the ERC. And this gets to the specific question that was just asked. Even if you have different businesses in the same controlled group, those are all treated as one businesses. So if you have a partial shutdown in a business in one of the affiliates and it is not nominal to the whole, that can cause wages paid to essential employees in one of the other affiliated businesses to qualify. So as we can see, and Mark's going to point out, things are really messy when it gets to real life. We have less opportunities for planning on this, but more opportunities for really taking a hard look at our situation to see whether or not we might qualify in situations where maybe at the outset we think we do not.
That's right. And it's going to feel really random, right? So a business that operates in a urban area that has more strict requirements is going to be subject to a partial shutdown for longer than a business that operates generally in a more rural area. And so you're going to get these distinctions. And the real weird thing is that even if I have 30 of my locations in rural areas, that one that I have in Kansas City or Columbia or St. Louis is going to have the potential to sweep in other business lines or other business locations and wages that I pay in those locations. And so, there's going to be some real randomness to it. So again, here's just an example where real life is messy. So if we think back to March of last year, we had a statewide in Missouri order that came in that said even essential businesses are required to cap their density in their building to generally 25% of the fire code limit. So let's assume that my fire code capacity is 20 people for my facility and I'm supposed to have 5 employees working there, so my 5 employees cap it out. So that means that I can't have my customers come into my store anymore. So while it's not specifically targeted to my industry, and while it may be, you might have to kind of jump through a few steps to see the restriction, you can draw a clear line between the government saying you're limited to 5 people here and my business saying, okay, well, if I can only have 5 people in my storefront, then I need to cancel walk-in appointments and I need to have a drive-up check-in service and I need to modify these other parts of my service delivery. And I guess the really hard thing is if we're drawing analogies between industries, it seems to me that there's an argument that is a enough of a modification to clear the nominal threshold if the question whether the burger slides across the counter or through the drive-through window is enough. So, we're going to get into some arbitrary line drawing here, and different clients are going to have to take different positions based on what they think is justifiable. But we're going to be in a world with a lot of this where we're going back after the fact and trying to trace through the orders that existed last spring and last summer when we didn't care about this because the ERC wasn't available to PPP borrowers, and try to piece together, well, what did we do when, and why did we do it? Did we do it because we wanted to, or did we do it because the government told us we had to? And so trying to stitch all that together with hindsight is challenging. I know Ashley asked a question earlier about resources available. We've started to stitch one together for statewide, Columbia and Jeff City. It's not ready for publication yet. Hush Blackwell, the law firm, has on their website in the states in which they practice a nice chronological summary with links out to the specific orders. That is another very nice resource that is published and out there, and can help clients to kind of work through what did I do, when, and why, and try to stitch together that argument. Okay, so we've covered the two gates to get into the ERC, but Jeremy, we have to think about not double dipping, right? So the December Act told us that we aren't per se ineligible for the ERC because we took PPP money, but we can't, so what we call double dip. So how does that all work?
Yeah, thank you, Mark. You guys didn't think you were going to get through an entire presentation without us delving back into the PPP for some length of time. So here we go. And what Mark said is exactly right. So moving to the next slide, we're in a situation now where we have a vast universe of businesses that were previously shut out of the ERC because of PPP, now eligible for the ERC, which is good news. However, we can't completely ignore the PPP because, as Mark rightly said, we do not get to double dip. We cannot use the same wage to support PPP that we are going to use to support a claim for an employee retention credit. And so we have a little bit of work to do. The good news is we have quite a bit of flexibility with which how to do it. And in situations where we maybe had uncertainty, the IRS Treasury has finally released some guidance or some guardrails that helps focus us on what to do. And again, we just put that reminder on there. It doesn't matter even if you are looking at an ERC during the covered period. You can do both. You can have the ERC and the PPP, and you can look at wages during the exact same period of time, but you just cannot use the exact same dollar of wage to support both. And so that's the work that we have to do. And really the situation, if we are looking at it on a going forward basis, that's going to be a little bit easier. And that gets to Terry's question. And again, basically the answer is you can do that as long as the PPP wages you are counting are incurred during your covered period, which can be between 8 and 24 weeks, they're good PPP cost. As long as the wages you are claiming for the ERC occurs during a quarter that you qualify or occurs during a period of time that you're subject to a shutdown, those wages are good. And as long as the wage you use for one is not the same wage you use for the other, after that, all bets are off. That's on a going forward basis. But we have a situation where a lot of businesses may be subject to the ERC for 2020. Mark, what do those businesses do if they've already received PPP loan forgiveness?
Thanks, Jeremy. Sorry, I was a little slow. I'm trying to figure out why my phone keeps ringing, even though I've tried to block it. So appreciate the tolerance of the delay here. So as Jeremy said, many of the businesses that have already requested forgiveness used only payroll costs to support the forgiveness. And now we're finding that as of December 27th, 2020, we're able to go back and retroactively claim the ERC for 2020. And so we have to figure out, how do we do that for somebody who's already submitted the application? So as Jeremy well described, we have notice 2021-20 that the IRS came out with earlier this year. And that provides some guidance on in which situations we get to kind of have a do-over and reallocate PPP wages and make them available to ERC, or in which cases the PPP application that we unknowingly filed to maximize the PPP program is now going to come back and sting us as a result of the IRS's narrow interpretation. Jeremy, can you help us through a few of the bullet points and examples on this?
Yeah, happy to do so. And again, we have the language associated with notice 21-20, but it can be a little dense. It takes a couple of readings to get through. So here's basically what it says. You are deemed to have used the minimum amount of payroll costs that you reported on your PPP loan forgiveness application necessary to support the forgiveness amount requested, taking into account everything, and this is key, that you included on the already filed PPP forgiveness application. Any excess payroll cost above that are no longer needed to support the forgiveness calculation are eligible for the ERC. The second bullet point, though, makes very clear, as does the notice. We are constrained by what we have reported on the PPP forgiveness application. So again, if you have not filed a forgiveness application, then we have the ability to influence this, and we really would want to do both of those together. So we've gone back and forth between when, at the beginning it was, we need to take our time for any number of good reasons to file for forgiveness. Then we finally had most of those questions answered. And for most businesses, it is safe to file for forgiveness. But if your business potentially could receive a 2020 ERC and it is not yet filed for forgiveness, we would recommend waiting to file the forgiveness application until we do the ERC calculation to make sure we can maximize both. Because whatever we report on the PPP forgiveness application, it will be our constraint as to what wages we are able to use for the ERC. So you take everything that's been reported on that forgiveness application and say, what is the least amount of payroll costs that I can use to get me to the forgiveness amount that I have reported on this application? So they maximize it, but within the constraints of that application. And what that means is that if you had non-payroll good cost during your covered period that you did not claim, and you did not report them on your forgiveness application, and you would like to later claim them on your forgiveness application to free up more payroll cost, you cannot do so. If it's on the application, we get to take it into account. If those non-payroll good costs are not included on the application, they might as well have never existed. So if a cost wasn't included on the forgiveness application, it does not count. And so we've then included this chart. In the interest of time and in the interest of clarity, I don't think we will go through this. Maybe efficiency is a better word. We won't go through this in a lot of detail, but this is a summation of the examples from Notice 2021-20. It starts with the most simple. We had a $100,000 loan. We only had payroll good cost of $100,000. All of those wages were eligible for the ERC, but we needed all $100,000 to get PPP loan forgiveness. We have no ERC eligible wages. If we instead had $250,000 of wages during that period of time on, say, a $200,000 loan, and we reported all $250,000 worth of wages, no other good costs, then based upon the notice, it says you reported $250,000 of payroll, assuming all 250 of that payroll was subject to the ERC, or at least 50,000 of it was subject to the ERC, we're only going to treat 200,000 of those wages as being applied to PPP forgiveness, even though you reported 250, because you only needed 200 and you get the $50,000 eligible for the ERC. And we go through some more examples after that if you had non-payroll good cost associated with it. But the thing is, you do not get to go back and report costs that were not already reported on your PPP forgiveness application and try to, after the fact, apply those against your PPP loan and free up even more payroll cost. So that's what we mean by being constrained. So again, a nice chart. But again, this is something we only really need to be cognizant of in those situations where you've already filed for forgiveness. If you have not, how we are approaching them is we are working on both the forgiveness application and the ERC calculation at the same time in order to make sure we are maximizing both. So with that, Mark, key takeaways or summaries associated with the ERC PPP interaction.
Yeah, and the optimization question is different for 2020 versus 2021, because in 2020, remember that your maximum ERC, if you've walked through either of the two gates or both, your maximum ERC is $5,000 per employee. So if you have somebody who makes $40,000 a year, there may be ample wages that we don't have a problem choosing between the two, especially if your business qualified for, let's say, 3 quarters last year. So we can look at the Q4 ERC, maximize it at that, and then go back and look at which employees didn't work in Q4, worked in an earlier quarter, and see if there's enough wages to borrow those from the PPP. So some flexibility there. In 2021, the game shifts because the ERC becomes a quarterly calculation, and we have the same interaction if the business qualifies for a second draw PPP loan. So it'll be more competition for wages in 2021 than we had it for many businesses in 2020. But our big takeaways are, to think of those two things as working in concert now. In the past, when we've said, let's take wages for simplicity on the PPP application, in our January presentation, we softened that. In our March presentation, we're continuing to soften that, and we have to consider trying to maximize non-payroll good costs if we think that there's going to be any sort of give back on the ERC eligible wages. And to the extent we can, we've been trying to fit clients into one of the two PPP forgiveness forms where they're providing the least specific payroll information to the SBA. But again, the bottom line point here, I think, is consistent with the thinking all the way back to March 2020, which is, given the choice, PPP is better than ERC. So we're going to make sure that PPP gets fully supported, and then we'll plug in the ERC wages thereafter. Jeremy, that takes us to some concluding comments, and then we'll see if there's any other questions we need to fit in.
Yeah, thank you. And again, appreciate everybody hanging with us. We had an hour and a half scheduled for this, thinking we might need the better part of it, and it's come true. So let's try to put a bow on this as best we can. We've covered a lot of information. So here are the key takeaways. Obviously, we've discussed this over and over. Once we've taken away the prohibition against PPP borrowers from claiming an ERC, something that was originally kind of a shrug of the shoulders is now something that could mean specific benefits to many businesses. And although there is no specific requirement stating that businesses above a certain level are excluded, having more than 100 full-time employees in 2019 all but eliminates the credit in 2020. So we need to be aware of that. If we have more than 500 full-time employees in 2019, that all but eliminates a 2021 benefit. So there is a practical limitation, even if there is not a strict limitation based upon business size. So that's the very first thing that we need to look at, because if we do not meet those qualifications, if we are a large business, in most instances, for all practical purposes, there is minimal to no ERC to be gained. And a business can qualify in one of two ways, or maybe both ways, if those periods don't cross. The first is a significant reduction in quarterly gross receipts compared to 2019 only. Again, always 2019 is the base period. If we're looking at a retroactive 2020 credit, that reduction on a quarter-to-quarter basis needs to be greater than 50%. If we're looking at 2021, that increase needs to be greater than, or that reduction needs to be greater than 20%. We'll let you, Mark, close with this last slide then.
All right, last three then. Again, as we talked about, cash basis taxpayers have some control over 2021 revenue recognition. Unfortunately, or fortunately, depending on your perspective, that allows businesses and nonprofits to control the timing of revenue recognition. And in those close calls, it could be the fact that last sandwich you sold made you 30 cents and cost you $100,000. And so it's something that we need to be really cognizant of in 2021. Businesses that have had a full or partial suspension can get access to the credit even if revenue is up. So that's the other key takeaway that we've spent time thinking about. And the last is the complication of trying to coordinate ERC and PPP benefits. We've had a lot of questions from clients and have helped quite a few to work through that optimization calculation. And in some cases, it's fairly nuanced. I know we had some questions about the mechanics of claiming the credit. How one thing that I want to make sure is really clear, because I'm not sure that it's been clear in what we've said so far, is that the design of this credit is as a refundable payroll tax credit. So there are specific taxes, payroll taxes that it goes against, but the excess is treated as an overpayment and becomes refundable. To my knowledge, Jeremy, we've had no clients actually receive a refund, but we've had some clients request a refund. And so we're waiting with bated breath for some experience on the time frame within which refunds might be issued. But there is quite a bit of nuance in terms of what wages count, what wages don't count. And kind of as a rough cut, we're taking the approach, well, let's take the obvious ones, run the math on the obvious ones. And then if we find out that everyone is capped at a $7,000 credit this quarter, then we don't need to get to the marginal questions of what other wages might we be able to count. But if we find that we are significantly short in a lot of cases, then that additional nuance to fold in ancillary benefits and things into our wage calculation becomes more relevant. So that's kind of a practical approach we've taken, is if it's 50 employees times 5,000 a person for last year, then stop there and keep it easy. So again, we'll throw it open for any final questions, and we really appreciate everyone sticking with us. We've had almost all of you stay for the whole time, and appreciate your attention.
Yeah, absolutely. And seeing no further questions, I guess Daryl is the sole survivor, so he wins the prize for having the one question that we were unable to clear. Oh, we do have another one that just came in. Any idea if it will extend? Yes. The American Rescue Program or Plan Act, the ARPA, that was just signed into law by President Biden approximately 2 weeks ago, that extended the ERC into quarters 3 and quarters 4 of 2021. So we are staring at a credit now that goes back all the way to March 13th of 2020 and will now extend through December 31st of 2021. Lori asked the question about what types of employees are excluded. This really gets to the comment Mark just last made. One of the, really all employees with the exception of, and we say exception, we're going to put a big asterisk related to this. There is some uncertainty related to owners, whether or not owner comp and spouse of owners qualifies. Because the rules reference the work opportunity tax credit. And so we are working with those definitions, and the work opportunity tax credit remains frighteningly silent for these purposes as it relates to owner compensation. I think our position is if you have owners that have no more than a 50% interest in the business, their wages are good. If we have owners that have a greater than 50% ownership interest in the business, they appear to be good based upon a very literal reading of the tax code. But I don't know that I would bank on that remaining the case, because I believe Treasury is aware of this question, and they are likely going to talk about it in the form of guidance. And from a policy standpoint, I would be shocked if they stuck with the conclusion that owner compensation, particularly more than 50% owner compensation, is good. So more to come on that. That's the only situation where we may have employees that are otherwise excluded from the calculation.
And Jeremy, just to color that a little bit, as we look to the definitions under the cross-reference that Congress has used, we end up with a peculiar result that children of an owner are excluded. Certain other familial relationships of an owner are excluded, but the spouse is not listed there, and the owner, him or herself, is not listed there, which creates this peculiarity. And I think that's kind of flavored Jeremy and my predictions of guidance to come from the IRS is for this particular credit, it seems to not make very much sense from a policy perspective to count my wages, but exclude my child's wages.
Yeah, that's a good point, Mark. I got us kind of off track, not off track, but discussing the owner comp. But there are certain familial relationships where those wages would not qualify. So it's generally think linear, children, parents, grandparents, those and the like. But yeah, there is no guidance as of yet related to spouses, nor is there any guidance related to the owner themselves, as Mark rightly said. Well, it looks like we've come up at the end of our time. Seeing no further questions, we'll pause just 1 second to see if anyone has anything else. If not, I would like to echo Mark's sentiments related to appreciating everyone's time and attention. We do have one further question that just got asked. Let's look at this one really quickly. So we could push our invoices for quarters 2, 3, and 4 in 2021 to meet the credit in each of the remainder of quarters in 2021. In theory, you could. Again, there's a lot of things related. There's a lot of factors that need to be taken into consideration. One, you have to, if you're on a cash basis of accounting, if you're on an accrual basis of accounting, that's going to be a little bit more difficult to make that work because you recognize income when it's earned, regardless of when you actually receive the cash. But if you're on a cash basis, you may be able to time the receipt, time the invoicing, thus helping you time the collection of cash that would make it easier for you to meet the qualifications in a quarter in 2021. And then that gets you, so if you meet one quarter in 2021, we think the rule is that should automatically qualify you for the subsequent quarter based upon that election where you can look at the immediately preceding quarter. So then that gets you 2 quarters, and then you're looking at whether or not you can meet that requirement then in, say, the 3rd quarter. So yes, you would be looking at, are there ways we could time our billing in such a way to help us meet this requirement, particularly if we're right on the margin. As Mark said, if pushing one more burger across the counter gives us an extra $1 of income and loses us $100,000 worth of PPP, of ERC, again, we need to be cognizant of that And, again, if you're a cash basis, using invoicing timing to help you get there.
So Jeremy, I guess an example in response to that, a question, if December was down 20%, let's say, more than 20%, December 2020 versus December 2019. So we know we got the ERC eligibility for a significant reduction in gross receipts for Q1. We'd want to try to get as much cash in the door for a cash basis taxpayer in the next week as possible, to increase the possibility that we also qualify, that we get Q2 to qualify, because Q1's already qualified under quarter 4. So we'd want as much revenue in Q1 as possible. And then we would want to try to engineer a reduction in Q2 and Q4 of 2021. If you were trying to optimize ERC and had perfect control of the timing of your gross receipts and could otherwise swing the cash flow impact. And so you'd get it in Q1, you try to get a more than 20% reduction in Q2, qualify in Q2, make an election in Q3 to use Q2's reduction to justify Q3 and try to get as much cash in the door in Q3 as you can, pulling it out of Q4 and then delaying some invoices in Q4 until 2022, and try to get a fourth quarter in. That would be kind of the golden scenario for a profitable business, where they would qualify for all 4 quarters, even though their income and gross receipts might actually be up for the year.
Yeah, well said, Mark. So with that, I think I've said this twice now, and we'll see if any other question comes in. With that, I believe we've answered every question. We will follow up. Oh, here we go. See, I knew it as soon as I said that. One more question. If you qualify for the ERC through closure only, do you follow state orders or county? The answer is yes. You would, either one is fine. State, local, federal government, doesn't matter who the authority is. It just has to be some government order, a government mandate. County would work, state would work.
And that's really the challenge, and why it's so messy, is when you have so many different bodies potentially telling your business what to do. And then at the same time, you're trying to look at customer preferences and best practices and keeping your people safe. There was a lot that was happening this time last year that we are now trying to recreate in our mind's eye. What did we do, when, and why? And so looking at all of those orders now with the benefit of hindsight is fine. We just have to piece together why it is that we did what we did and hang that on a government body telling us to do so. All right. Thank you, Jeremy, for another great presentation. And I think we're signing off now.
Yeah. Thank you, everyone. Have a great rest of your day.
Bye-bye.